Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Bernie Leas. Bernie began investing in real estate in 2018 with single-family homes, but transitioned into multifamily in 2019. And he's a partner in $12 million of assets and a passive investor in 130 units. So thank you so much for coming on, Bernie.
Thanks for having me, Charles. I appreciate it.
So give us a little background on yourself, both personally and professionally, prior to getting involved in real estate investing.
Yeah, probably a similar story, Charles, as a lot of people. Just, you're working your W-2 job, think about long-term, taking care of your family, putting money in the 401k and retirement, things like that. But I always had this itch to do real estate, but never really took that next step for a long, long time. And then, my job was going well here in Boise. I got married, I had a beautiful wife and a daughter. And we were kind of going through, and we're like, gosh, we want to create some type of like a separate income stream that's outside of our normal work, and just kind of build towards the long term for kids' college, for later on in our lives, things like that. And real estate seemed like one that we wanted to try, and so we kind of pulled some money out of our house on a HELOC and started looking for single family houses in Indiana. And that was kind of our first step to doing a real estate investing.
Interesting.
Yeah.
So what was the main, factor? Because there's a number of different financial vehicles to get you where you want to go with that goal. Why did you think you chose real estate over anything else?
I think for us is, if you look at the long-term success of a lot of people who've done it for a long time, a lot of them own real estate and use real estate to build long-term wealth. Our approach has always been, my wife and I, and my partner too, Mike, has been like, we're not investing for a 2-year timeline. We're investing for 10 to 20 years, right? And so we thought real estate was a great way to do that. We also like real estate because there's control, right? You can put $50,000 into Amazon stock and you're at the mercy of Jeff Bezos and his team to do their thing, right?
Right.
Whereas with real estate, you can kind of put that money in, and as a GP or as a lead owner, right, you can sit there and push certain levers to increase value and decrease costs and things like that. And so that was also very attractive to us. And then a benefit for us too was just that tax benefit that the government always writes in for real estate investing. It's such a beautiful thing, right? Why not take advantage of it if you can't?
Yeah, definitely. So tell us about your first investments. You started off in single family. So kind of how did that turn out, and how you got started with that?
Yeah, we're looking for houses. Living in Boise, Idaho, houses were super expensive here. The market's very hot, and so nothing cash flowed. And so I had in my W-2 job, I had been to the Indianapolis, Indiana area. Knew it was a great working class town, growing really fast. And there's a lot of single family homes that were in that kind of that price range with comparable rents that really worked well for us on a cash flow basis. So we started doing some networking, and we found a group that helped put us in touch with some local people on the ground, both an agent to help buy who specialized in doing out-of-state investments, and also from third-party property management group that could kind of take over the asset for us and run it on a day-to-day basis. And that allowed us to really dig into the market and start asking questions of these guys and gals of like, hey, here's this neighborhood, what do you think? And they would go like, ooh, not good, or like, it's a great one, focus on that. And that really helped us kind of refine our search and make it a lot easier, because there's hundreds of listings that are coming through, and helped to refine us. So long story short, we spent about 30, 45 days looking really hard and closing our first property. And then about 30 days later, found our second property and closed on that. And we held those for almost 4 years, Charles. And we exited last summer, and they did great. You know, it was mostly an appreciation play because we invested in a great market, but they both paid off, you know, in multiples of dollars for us. So can't complain. It was a really good experience, and I feel bad for people who had those bad experiences with out-of-state investing, but ours was never that way, thankfully. Knock on wood.
Yeah, I want to talk about that because long distance investing is an animal to its own. I mean, you explained a little bit there. You had an agent that was very familiar with what you're trying to do. You had a property manager, these are the most important pieces of the puzzle. But as I read, like, you've never stepped foot in any of your properties. So how were you? Tell me about that whole process of when did you go out there initially and do some pick out different neighborhoods and parts of the city that you liked, and then when stuff came up, you knew it was in that area, you took it? Or were you really relying on all of your professionals and like this team you had put in place there?
The latter. I think maybe the former would have been the smarter way to do it, Charles. But for me, as you know, in my W-2, I have vendors across the US, even across the globe, that I've never really met in person, things like that. So I have systems and processes in place to vet people out. And you also use, validations and recommendations from people who have used them, right? Mm-hmm. That's also a big key for us. And so I think a really, a big takeaway for us has been networking well and not going on to Google and typing in, third-party management groups in Indiana. It's actually talking to people who have been in that market and saying, like, who do you like, right? Who's a good reference? Who's a good party? And you kind of like to whittle those down. And that's the kind of the way we came to our conclusion. And then just trust the professionals. Once you vet the person out, trust them, right? They've been doing this for decades. There's no reason for me to sit there and try to reinvent the wheel. If they say it's a good neighborhood, it's a good neighborhood. And I go with that recommendation.
Would be what you would suggest to anybody that wanted to get into out-of-state landlording? Would there be anything different that you did or didn't do that you would suggest to someone else if they said, hey, I want to do kind of what you're doing with single family houses in a market, thousands of miles away from where I live?
I think most of what I did was fine. I think that maybe the lesson learned for me was be a little more active in that transition period of once that you have the property closed and that property manager group comes on board. We kind of let them do their own thing. And what we found really is they don't have the same sense of urgency that we did. So it's like, we get the house closed. We want to do some little cleanup and refreshing and get it going. And they're like, oh, the vendor's 3 weeks out. And I was like, oh, well, that's a month payment, right? That we're out of pocket now, right? And so I think for us, it was more like, get on the same page and make sure they understand your timelines up front and they're agreed upon, and then kind of move forward versus saying, like, you're the professionals, do your own thing. I think there could have been a better process on our side to push.
Yeah, you can be very cavalier when you don't have to pay that mortgage payment, right? So
that's your money, right?
That's so true. I like that idea too, is you're being a little bit more hands-on with the asset management, and then you're kind of handing over something that's already running to a property manager or something that's ready to be rented out, whatever it might be. And then you can kind of get that going, and you're kind of all set for hopefully another year down the road until that lease comes up. Why did you transition to multifamily investing in your second year of real estate investing? Because every time I really talk to investors that start it in single family, it always takes them several years to make the change. The same thing with me. I didn't start off as single family, but like small multis. And then it took a few years to get into actual commercial multifamily, small ones.
I wanted to go into multifamily right away, Charles. That was my goal. But instead of like going like, well, how do I do this and be creative about it? I go like, well, I can't do it, right? That limiting belief of like, I'm just me. I only have X amount of dollars. There's no way I can buy an apartment building. That was why. And so the compromise for us was, let's just buy some multifamily, or let's buy some single family houses. The problem with that is after we closed those first two deals, my wife and I looked at our bank account and said, like, crap, we're out of money, right? How do we scale this thing, right? And so these are cash flowing properties, but they're throwing off a couple $100 per house per month, and you're not going to go out and buy more properties doing that, right? And so we had to pivot and say, okay, what's a way for us to get to where we want to go faster and to scale this more quickly? And multifamily was the way. And so then it was like, well, how do we change our mindset to then approach that, and how do we solve that problem of getting in multifamily when we can't maybe pull down a large building ourselves? How do we network with other people so that we can do it as a group and do it that way instead? And
that's where you found partners that were on the similar page to you?
Yeah. So my partner, Mike, we worked together in our W-2. And so, my wife and I were kind of crazy, Charles, is that we found out she was pregnant, and we're like, oh, wow. And then the next day we put our house on the market to sell. Right. And so, our idea was that we would sell our primary house because we had some great equity built up into that, and use a lot of that as a way to fund our first deal. And so talking to my buddy, Mike, I'm like, oh, he's like, what's up in your life? I'm like, well, we're selling our house. He's like, why are you doing that? started talking about multifamily, and he's like, well, tell me more about this. And so, fast forward 4 weeks, and he's like, this is great. He's consumed podcasts and books. He's like, I want to partner on this with you. And so we started to work together. And then from there, it was just like, how do we then, find our markets and get this going to the point that we can kind of pull down our first property.
So give us a little overview of your current investment strategy and criteria. Like, what are you guys doing right now? What are you focusing on and what markets?
We're focused on the Southeast, Charles. That's kind of our big one. We like the migration of the population, the long-term trends for that. We look at assets that I think are less risky, right? We like stable stuff. 2 of the 3 properties that we pulled down are less than 5 years old, right? They're fairly new. We don't like really old. We like less than 30 years old. We don't want to have huge value adds where we're ripping things down to the studs and doing lots of replacing. We want to maybe we update the paint, maybe some countertops and some flooring. That's about as far as we want to go. And so we know that limits some of the upside in terms of the turnaround. But because we syndicate these deals and we're using other people's money, including our own, to build this, we didn't want to do anything in those first few years that wasn't safe and conservative. And so we would rather under promise and over deliver on our returns and say like, hey, here's this great unit. We're going to tear it down in 3 years. It's going to be worth 5X. We're going to do some light touch-ups or manage this better and cut the expenses down and push rents to market levels. And then you're going to get really solid returns. And over the course of, our 5 to 7 year hold period, you'll probably see, 15 to 20% annual returns on your money.
Yeah. That's great because you're getting, so you don't really have to deal with too much of the bones of the property, as we would say, really. You're really dealing with when you're putting money into those units, you're actually seeing a return on it. It's not like I'm changing a roof and you're not going to raise your rents because you change your roof. No one's going to pay you more because it doesn't leak. And so and actually the money you're investing, you're going to pay a little higher for that, but the money you're investing, you're actually going to get it out in 2 or 3 years, whatever it is. And that's awesome. That's a great strategy. One other thing too, is I see with people, even with older properties now, when you're getting into an area where rents aren't increasing as fast, they're kind of, with us, we're doing with some of our properties, we're doing kind of minor value adds on some of our units. And you're just doing a little bit of work here. You're keeping them rent. You're really worried about occupancy because you're not, hey, you put X goes in, you don't get 5X out or whatever it is. You know what I mean?
That's right.
And so it's not really discussed as much, but it's a great strategy.
We've been pretty fortunate, right? And we passed in a lot of deals, like the 1960s, and the broker's always like, oh yeah, just put $5,000 per unit, you can increase rents by $500 a month. And it's like, maybe, right? But I don't have unicorns and rainbows outside my window either, right? And I'd like that as well. So I think those are the things, right, that we've been very cautious. And again, it goes back to, if it was my own money and I'm just throwing it at something, I'm willing to take a couple of years of hardship to maybe get it up. But when you're dealing with other people's money, we want those stable things. And for our investor avatar, our normal investor is, they're not looking to get rich overnight and they're not looking to retire off this money, but they want those stable returns that slowly build over the long term, because that's how they're thinking as well. And so we want to make sure that the assets that we do purchase match those values of our investors as well.
Oh, that's awesome. So let's talk about that with other investors. I mean, your first year syndications, you raised over $3 million and over $500,000 for your first deal, which is definitely higher than most syndicators in their first year or their first deal. So can you tell us how you did that with having, I guess, a track record at that point of maybe just a year or two of investing in single family and then going right into, let's say, larger multifamilies?
Yeah, I think the biggest key for me was my partner, Mike, right? He was well networked. He had a good network of people and a good background. But I think the other thing for us is that when Mike and I decided to do this, Charles, it was 2019. We didn't pull down our first deal until February of 2021. And so in the meantime, while we were looking for deals, as we were talking to people, we kind of identified who our investor would be, like-minded. And as we talked to our friends and people in our network, we would start to say like, yeah, we're looking for real estate. And here's kind of our criteria. And people go like, oh, real estate, tell me more, right? And that would the people we kind of bring into our network. And we just kind of keep talking to them on a regular basis throughout the year. So that by the time we finally got to our first deal, they didn't say like, oh, who are you guys doing? Why are you doing this? A lot of them were like, oh yeah, we've been talking about this for upwards of a year and a half sometimes, right? Tell me more. And that allowed us, I think, a little bit of an easier transition in that first deal, because raising $600,000 in the first deal, that was a big like scary moment for us when we signed those papers, right? So it was nice to have that. And that just for us, Charles, was a kind of a domino effect, is once you have that first deal in place, the big thing for us was we need to perform. And so it was like regular communications with our investors, good newsletters. And then when that quarterly dividend was scheduled to happen, we hit it, right? And we hit the minimum or exceeded it. And that allowed us then, as we got to our second and third deals, a lot of those people from the first deals invested in both of the second and third, and also brought in people who they knew as well that were interested in it, and helped us to expand our network. So it was easier on those raises on deal number 2 and 3.
Oh, that's great. Yeah. It's funny how that works, right? You have one investor. We have a handful of investors like that. You know what I mean? That went to one, and then they did a second one, and then like, hey, let us know if you have anything else on the third one. And it's kind of like they're testing it out. They're seeing how it works. Because most people, it's not just testing out you as an operator, which is one part of it, but it's also a lot of people haven't invested in syndications. And I imagine some of your passive investors own some small properties that they rent out. So they understand real estate. They just probably haven't gotten into properties as large. And you know what I mean? Is that true?
Exactly. Yeah. Very, very true. Yeah. And a lot of guys were like us. They're like, I would love to do this, but I just don't have time, right? Between my career and family and things like that, I don't have time to find it. So I do have the cash. So you do it for me. I got a good friend in California. He's a CEO of a healthcare clinic, right? And he texts me every quarter and goes like, this is the easiest money I've ever made. Keep it up, right? When's your next deal? And that's kind of like, but that's what he loves, right? Because he wants to be in real estate. He loves the tax write-offs. He loves that building that wealth long-term, but he has no time to do it, right? And so he just likes to watch the bank account every 3 months, right? That check hits, and that's what he wants to have, right? And it helps him build that long-term value that he's looking for outside of his W-2 job.
Yeah, it's great. It's great. So one thing I see with new investors is the analysis paralysis. And it's like, how are you able to overcome this? And how do you suggest to new investors to overcome this? Because it's very, I mean, when you meet someone face to face and maybe at a conference and they're telling you about a deal and they're like, they obviously have it. And, it's very difficult to tell them or how to get around it. How would you suggest to someone, how did you get around it? And how do you suggest to new investors that might speak to you first?
I think the biggest thing for us is find people who are experts or who could mentor you, and whether you're paying for it to be in a network or finding somebody who's willing to give you at least guidance on it. I think that's the biggest key, right? Because if you go online and you go to even a market you like, and there's 1,000 listings sometimes, right? There's just tons of listings out there and brokers are hitting you. And I think for that is that person can help to kind of refine, Charles, and really kind of filter down into what you need to focus on. I'll give you a good example. Is like when I first started this, I was like, I love Atlanta, great market. I finally talked to a guy who'd been in Atlanta for 10 years. He's like, don't even worry about it. It's mature. You're not going to get into the market, especially because you're in Boise. Here's why. Here's what to focus on instead. And that really allowed me to pivot. And that's where I started to look at Middle Tennessee, where we're invested in now, right? That was a big eye opener for me. So I think for the new people to get into that analysis is like, is find somebody who can help filter down your criteria. Be willing to stick to your criteria. That's a big thing. And then be okay with small steps. I think a lot of folks are like, how do I underwrite this deal? What's going to happen when I close it? And don't even focus on that. Just focus on, finding deals that fit your criteria, walking through the underwriting or the financials and making sure it works, and then moving on to the next step, right? I think people try to look at this like, what's it going to look like in 10 years? Get to year one, right?
Yeah.
That's the first step.
So you've actively invested in real estate. You're syndicating, actively investing again in real estate now as you're doing it, as you're growing your business. You have a W-2 as you're doing this. I mean, how do you have all this time to do this? And I mean, how are you working with outsourcing tasks and, freeing up time? So you're really, I imagine, spending most of your time finding deals or talking to investors.
Yeah, we split up. My partner does most of the investor stuff for me. That's kind of Mike's wheelhouse. So that's where he does the newsletters for us and he takes the investor questions. A lot of my outsourced tasks are, the third-party management, Charles, as we do that, right? We don't manage our properties directly. Yeah. That's done by them. We just have weekly calls and check-ins that take, 20 to 30 minutes. They're pretty fast. We have a kind of good cadence down there. And really for us, it just on a regular basis, just, sending little notes to brokers or how's it going, what's going on. It could be an email, it could be a phone call. And I can do that early in the morning sometimes because of the time difference or, during my lunch break, things like that. That's kind of how I do it. We don't outsource a lot of it. Other than that, bookkeeping, of course, is done by professionals with the accounting. But in terms of everything else, we keep it in-house. But my partner and I are pretty good about this. We've got a system down that helps us out. So
nice. Yeah, the outsourcing of the third-party management is a great thing to take off your plate. So you can, especially when you're acquiring, and you guys are definitely in that mindset of acquiring properties, not really worrying about managing them. Did you have to go through? Now talking about management, just off topic for a second. Did you have to go through multiple management companies when you started, buying these larger properties, or did you find one through a referral or?
Yeah, when our first deal, we kept the manager in place. Unfortunately, about a year, we actually had to replace that group and bring on a new one. Our third deal, that management group in Clarksville, Tennessee, we've been networking with her and her team for a couple of years now, looking for deals, and they're outperforming everything, right? They're killing it right now. So we're very, very fortunate to have them on board. But it is tough, right? It's a tough thing. And I'd say, my biggest lesson learned is make sure that when you vet the manager out, that they have the same mindset on the property as you, and their values and their systems work as well too, right? I think for us, for Mike and I, right, we're very proactive. We don't like to see the fires. We like to kind of see the smoke and take care of it right away. And in some cases, our first property manager was like, if it was a fire, he would address it. If it wasn't, he would kind of let it smolder. And for us, that was really, really tough because I think for us, it caused churn with our tenants.
Right.
And it also costs money. And so, to explain to our investors, like, well, the dividend would have been X amount higher, but we didn't address something in time. And so it cost us $3,000 of missed rent payments by this tenant. We didn't evict right away, right? Those are kind of tough conversations to have. And so I'd say, make sure you're value aligned on that, because that's so important, right? It's not like you're wedded to them, but you're working with them pretty closely.
And they're the ones that are dealing with your tenants on a daily basis. And it's great when you say about that, where your first property manager is, I was told by a property manager one time that they're talking about another property management company that kind of dealt with slummier properties, and it was like, they know how to really control expenses. And I was like, that's a great way of saying that they just like fix stuff when it's really like you said, like a fire happening. And I was like, what a classy way of saying that. But it's true. Like, you first manager was kind of like that, where you're getting stuff, but then it balloons into a huge problem. So it's really, I'm definitely a proactive owner as well on fixing stuff. So it's, we see something, we're like, listen, this is going to be something that's addressed, and you got to let your managers know, like, hey, let me know on this if it's something that we don't see when we're walking the properties on our normal visits. So very important.
I think for us, I agree totally. I think for us too, it's been that you have to realize it's a two-way street, right? I think some people go and say, you're the property manager, you work for me, you do what I say. And I look at it as like, they're the property manager, but we are one of potentially dozens of customers, right? And hundreds of properties that they're overseeing. And so it goes both ways. And so we're very transparent about, here's how we work. How do you guys like to do things like for approvals, for invoices and work orders and things like that? How do you guys turn? What's that kind of stuff? And we make sure that we are super reactive and responsive to them as well, so that they can do their job quickly as well, right? We want to be a good partner for them. We want them, because that helps Charles with us, is when we do have to make those phone calls or ask for those favors, they're more willing to do that because we've been so good to them throughout the relationship. I think that's a big key for us too. It's not just a one-way street.
So normal questions that we ask every guest. What are common mistakes you see real estate investors make, Bernie?
Oh gosh, I think the big one is lack of networks. I think a lot of people, they start out in it, they've joined a guru's program who says, like, you can use other people's money to become rich overnight. And I think that's a great, it happens for some. I think, find a good network, a good group of people, whether you pay for it or you not. Find some people that can help you kind of, vet deals, vet markets, and really kind of, guide you along for that thing. I think the other one too is realize that all the guys and gals out there that are posing in front of their Class A 300 units in their Lambos saying, this is how I did it, I made this. That's the rarity, right? I think you have to look at it as make sure you do this the right way. And I think most people that are successful when they build this, they do it the right way, which is you build long-term. Instead of viewing it as like, what one deal can I make that'll allow me to quit my W-2 and be a real estate investor full-time? I would have said, I had a good analogy from a guy that was my coach. He's like, think of it as a conveyor belt, right? And you're stacking properties on this conveyor belt. And as the conveyor belt moves along, those properties start to mature. And then you might take them off the conveyor belt through a refinance or a sale, but you're still stacking stuff on the beginning of that conveyor belt, right? And over the course of time, you have a lot more properties on that belt. And that is where you start to build the wealth and the value in this, right? And think of it that way. I think a lot of folks seem to turn out like, what one deal can I invest in that's going to allow me to pull the ripcord on my W-2? I just don't think it's just not a viable option, right? It's not realistic. And so think about it that way and do that. That's been a big key for us. And then over the course of time, I think too, is be willing to not do everything, right? I think, and so people can say like, hey, I could own 100% of this deal, or I could own 10% of this deal by bringing other people and other parties. Think of it as a bigger pie. I think you maybe have a smaller piece, but you have a smaller piece of a lot more pies than just a big piece of one pie. And I think I see a lot of folks who are trying to do it on their own initially at first. And it's going to be tough, right? I mean, you might even have $250,000, Charles. It doesn't get you very far in multifamily nowadays.
No.
Right. right? So, but $250,000 split across 5 or 6 deals potentially, right? That can get you a long way really fast. And in 5 years, you'd be in a much better spot. So I think, think of it that way. I always try to think of it of bigger pies, but more pies that you have a piece of.
Yeah. It's also funny what you say about the one person or the one investor waiting for that one special deal. And those people, when it goes down. Well, I mean, you're going to be waiting many years, most likely. And, to find that if it ever does happen. So it's kind of another paralysis, I think you'd say, just kind of not taking action. And that's the reason. So,
a good example would be like, when COVID happened, we had a deal under contract we had to back out of, right? Because our investors said like, oh, sorry, no, we're not going to do this. And that's normal, right? But a lot of people were saying like, well, COVID is going to cause multifamily to decrease by 15 to 20%. So you should wait 9 to 12 months. If we had waited, Charles, we would have missed out on our first 2 deals. And our first 2 deals have appreciated, if at 20 or 30% already, right? Since we pulled them down. And so I thought you're right? There's never the perfect time to get into the market. I say the perfect time is now, right? Just do it, especially if you have that 5 to 10 year time horizon. If you buy a really good asset in a really good market, you'll make money on it in 5 to 7 years.
Yeah, I totally agree. It's very difficult if following those rules to lose money. I agree totally with that. Totally. What do you think are the main factors that have contributed to your success over the years, Bernie, whether it's professionally prior to real estate or during your real estate career?
I think the biggest one is people, surrounding yourself with really smart people. I like to surround myself with people who are smarter than me, right? If I'm the dumbest guy in the room, then I know I'm in the right room. That's kind of right. That's a big one for me, Charles, right? I mean, I want to be pushed. You want people who are successful, who've done this before, who can train you. And you want to feel like I like to feel insecure. Like, ooh, am I really in the right setting? That's a good feeling for me. I think the other one too is be willing to put in the work, right? This is not easy. And this is not an overnight success, but be willing to say like, hey, even though I'm doing really good on my W-2, I've got a family and kids, I need to spend time. Set aside some time though to make yourself better, right? To learn. And that's like reading articles, reading books, listening to podcasts, calling people who are successful and finding out what they do, right? How they get there. Those are the things that start to, add a little more tools into your belt that over the course of time will make you more successful. That's been a big key for me.
Yeah. The education never ends. So,
It doesn't.
Bernie, how can our listeners learn more about you and your business?
Yeah, thanks. They can check out our website. It's elementalequityllc.com, or they can just send me an email at bernie@elementalequityllc.com. Happy to answer any questions you have.
Well, thanks so much for coming on today, Bernie. Looking forward to connecting with you here sometime in the near future, and have a great rest of your day.
Thanks for having me. Appreciate it.
Talk to you soon. Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.